Welcome everybody to Wall Street Reporter's next Super Stock live stream for March 4th, 2021. We are back with Skylight Health, SHGFF, Prad Shaker. This is a stock that's has been starting to make a massive move. We're looking to see if this is going to be our next 10 bagger. We've had already this month two 10xers, one 50x since December. So Prad, you need to catch up right now.
Oh, we got lots to go. There is lots on the come. That's for sure.
We need to see the last guy, the guy we had before. He had 100 bagger stock in the energy space. All
right, challenge accepted.
I like this. This is it. So we need 100x Skylight Health. So let's talk about how we're going to get there. Let's talk about 10x for now, just because that's the appetizer. So what's going to make this a $15 stock? US. You got some news you released this morning. The market, the Nasdaq has taken a big hit, last couple of weeks, so the market's not really paying attention. But otherwise, it would have been a massive, would have massive launch. So explain this deal, the latest acquisition you announced today.
Yeah. So this is funny because everyone knows we're working on closing the sixth acquisition, which, when you deal with more institutional sellers, you deal with more institutional lawyers, and it just takes longer to finesse every word. I've never seen grammar get to such a level of detail as I have in this negotiation, but it's all positive. It's all good stuff. It's moving forward. But yeah, look, the reality, Jack, is we were trying to time things to close after, and announce after, but the pipeline's just getting too full. So we just got to start coming out with some deals now. So, these three we kind of, grouped together and put out because quite honestly, we got to get moving on them. There's more coming in and we just can't sit on too much in the pipeline. So it's not a bad problem to have. But yeah, so it's certainly exciting.
You have a quality problem, actually. It's a quality problem. A lot of companies wish they had problems like you.
Yeah, sure.
You got 10 million. You're going to add 10 million. This is another 10 million you're adding to.
Yeah, and again, this isn't even taking a dent out of that 100+ million pipeline, right? So we still have a lot more we're working on, and as they keep coming, it's just uncovering more and more. In fact, just this week alone, we've had 2 inbounds reach out to us after announcements we've made in markets now saying, hey, would you consider us? And so the market's opening up. What people need to just, what I just keep reiterating and what people need to look at the market size here, right? We're talking about, 500,000 practices out there today, out of which over 400,000 of them fall under 10 million in revenue. These are small to independent physician practice offices. There are more deals that are possibly out there today than 10 Skylight Healths could try and ingest. And the reality is we're going to just continue to be so busy because there's so many opportunities out there, and this whole that shift to a better infrastructured organization to meet the demands of the growing healthcare industry in the US. It's consolidation with primary care practices. It's happening. It's not, can it happen? Will it happen? Is everyone going to want it? It's happening because the pressure is squeezing the small guys out. And so, Skylight Health is there to provide a better opportunity for these practices to join with than what they have today in the market. And it's showing. We're seeing a ton of deal opportunities, and we're staying super disciplined. Look, we're 3 to 5 times EBITDA. We've been like that since the start of all our acquisitions. We're proving to the market that there's no, value contraction here. There's no paying up for deals, and what U.S. investors are loving about the story is it's not just an M&A story. It's how you're going to take these clinics and transform them 500 to 1,000%, by being able to bring them to the future capability of playing in that healthcare space, right? Where guys today are paying like 14, 15 times EBITDA for the same transactions. So there's a huge upside, and that alone is just reflective. But yeah, these 3 deals, Jack, right up the sweet spot of what we look for: primary care, massive opportunity for short-term growth, and ton of opportunity for long-term organic growth.
Okay, so I'm getting like a couple takeaways. Number one is, which we've talked about before, is you have this massive consolidation opportunity in U.S. healthcare. This is like, you kind of one of these classic, consolidation roll-up opportunities out there. You're making it happen. But what's more important is kind of like your value add. The reason you're not just doing a roll-up, you're not just buying a bunch of things and, putting them together. So you're really creating a value where you're able to, with your model, increase those revenues post-acquisition by 5x, 10x, basically. Is that correct?
Yeah, and even more, right? So, on a fee-for-service model, which is how, majority of primary care practices work today, right? On a fee-for-service model, which is you go in, doctor gets paid, payer pays the doctor, right? The average revenue of these clinics is about $150 per year, which is about one visit per year, right? On average, patients should be coming in 3 to 4 times a year. So to bring that practice from 150 to potentially, improved revenue through improved visitation, frequency, access, telemedicine, things of that nature, you're right. That gets that 2 to 3 to 4x return on that practice, right? But the way the healthcare market is moving is insurance companies are actually saying, hey, physicians, we want to stop paying you on every encounter. We actually want to pay you a fixed amount per month per patient, because if we pay you to do a better job with your patient, then we're paying less money out on the more expensive surgeries and emergency room visits. And we're not talking about a small capitation fee. Like in Canada, capitation fees are like $200 a year, $300 a year.
What's a capitation? What is that? What capitation is?
That's like me saying, rather than paying you every time the patient comes, I'm just going to pay you a fixed amount per patient per month. It's like subscription revenue. It's very similar.
SaaS model, which
exactly. Yeah.
Months.
But we're talking like $400 to $1,000 per patient per month, right? That's $6,000 to $12,000 per year. So you're talking about clinics today that are doing about $150 a year, with the potential of going to $6,000 to $12,000 per year per patient, right? Just to break that down, if you even look at the patients we have, right? So let's say 20% of our patients, which is on average Medicare patients, right? Senior populations. If they were to subscribe to a Medicare Advantage product, on average, a Medicare Advantage product is about $1,000 per patient per year. We're talking about, call it $4.5 million on our 20% of that patient base today, to over $300 million on that exact same patient base in a managed care product from Medicare. That growth, right? That organic growth happens because of what we're able to bring to these practices in terms of infrastructure and scalability.
Okay, so you're saying based on what you have right now, you're saying you can do 300 million revenues.
Based on what we have today and the capabilities we're building towards, that's just the minimum. I'm only talking about 20% of the patients. I'm not even talking about the other patients that could benefit from other kinds of value-based contracts.
Okay.
Value-based contracts is what we want. That's what is ultimately leading to this per member per month subscription style model. Okay,
so it's very interesting. You have this. It's kind of like this arbitrage opportunity here. So right now, I mean, with what you have, built in to your model, baked in, sort of, and this is what you have right now is, that you're going to be able to ramp up these people into about 350 million revenues in the next. How long is it going to take you to get all the?
Every market's different. Every clinic's different. But let's say the next 12 to 24 months. I mean, look, you're talking about technology, data analytics, and payer contracts. They don't take long to put together, but you got to be able to put the foundation in place, right? Which is why you see that organic growth just by improving the practices. But that's not factoring in this massive increase in potential by switching to these value-based contracts. If I did nothing else, if Skylight Health did nothing else, Jack, we didn't buy any more practices, which, by the way, we almost have no choice, not to do that, because there's so many out there that are coming in, with this price point. But if, let's just say we stopped M&A activity, right? The company would see, a significant growth on just revenue from existing platforms alone. That's why the story is resonating so well, because the M&A is a huge driver. A lot of companies do M&A, but it's the organic growth that is almost the icing on the cake that's coming for free, right? You're getting the value on the M&A, but the organic growth is free.
And also, I think we should emphasize that's really the organic, creating the value. That's the thing that investors are paying. I mean, institutions are paying for. That's the thing that they want. They want to say, okay, anybody can do a roll-up, okay, but who can they actually operate in? Can they, create value from it? That's the key thing. Okay, so
exactly.
Okay, so takeaway is based on you got this 350 million plus, and you got this like growth on top of growth, basically.
Right. Right. So what you're going to see is you're going to see that $70 million, that $100 million exit potential this year, just on M&A alone, right? I mean, there are so many deals that we have to go through this year one of the things we're working on internally right now is trying to drive up that capacity, right? We brought on senior executives. We're building out our corporate development team. We're building out our infrastructure and integration team, because we want to be able to keep up with this capacity this year and next year as we continue to grow. So you're just on that nature alone, you're going to see a huge trajectory of growth, because the market has so many opportunities for acquisitions within this price range that really nobody's focusing on. Everyone's focused on the higher value assets because they want to get there faster.
That's the other thing I want to emphasize. So what you're doing different is there's two things that Skylight is doing that's different. One is you got this organic growth model where you can really essentially increase the revenues by 10x of the clinics you buy. But number two is there's a lot of institutional players, not institutional, like the private equity players that are they're active in the space, but they're going after these kind of massive. They're looking at these 100 million plus deals, 75, and they're paying. Let's talk about the difference between the multiple they're paying, what you're paying, and kind of.
Can I show you my screen? Can I show it? I want to show it to you because I actually think it's on paper, so it's not just me saying it. So,
can you show? Just go to the main slide, like it just sort of shows one at a time. View, I guess.
Yeah. So I want to just thank obviously our team at Oppenheimer, our U.S. banking partner that put this together for us, because this is obviously something that we've seen from feedback and something that they were very excited and why they're excited. So first of all, here's where I'm going to show you right here. Sorry if I'm looking down, if I'm looking at the screen.
Can you show just the main slide, just the big view, the big.
Can you not see the screen?
I see it by if you can just make it the view so it's one slide at a time. Right now I'm seeing on the sidebar, I see the what do you call it?
Oh, you're doing a.
Yeah, it's going to make it bigger. If you just close those out, it'll make it.
I don't know why it's showing you my other screen, to be honest with you. I think it's something on the screen sharing, Jack.
Okay. So
I'll tell you what. I'll make this smaller here so that you can see this better. Is that okay?
Yeah. And if you can, is it possible to make this bigger now? Expand or? No. Okay, that's it. Well, okay, yeah.
Is that better?
Yeah. Okay, good.
Okay. It switches otherwise. Okay. So look, this is not just us saying this, right? Look at the average per member per month rate on a Medicare Advantage plan, $968 per month, right? That's per month, not per year. Medicaid Advantage, $410, right? So you're talking about $6,000 to $12,000 per year just on sort of Medicaid alone. So to your question, Jack, here, look at this. Look at the median EBITDA range that companies are paying for right now on the U.S. Private equity companies, mind you, and some soon to be public companies like Cano Health. Right, 14.7 times EBITDA is what they're paying for practice groups on the U.S. Now these are large transactions, right? I mean they're not small, but if you look at smaller transactions like 60 million, right? Look at their multiples. Look at this one here: 60 million in revenue, 7 million EBITDA, 13.5 times. In the last 3 years, the median price paid for practices has gone from 9.5 times to 12.3 times, and it's only going up, right? And the reason for that is because they're all buying these already converted clinics that are already doing this value-based per member per month subscription model. What Skylight's doing is we're not paying the 12 to 14 times. We're not going where it's crowded and expensive. We're going to this bigger green space where more practices exist, and we're paying a discount. We're paying 3 to 5 times. But these clinics haven't converted yet. So we're converting them. And in converting them, our shareholders get 100% of that result organically. They're not paying for that. So you're getting a fast way to acquire a patient base rather than opening up organically, right? So what Oak Street Health did, right, just on this slide here, so they're de novo. They only open up organically. But it takes them 0 to 2 years to build a patient panel, a full patient load, right? So what Skylight's doing is we're basically building it instantly because we're acquiring these practices that are already full of patients. And then we're just putting in the infrastructure and we're converting them. And in converting them, you're getting to that 500 to 1,000% growth because you're going from $150 a year to $6,000 to $12,000 a year. And by the way, the patients are benefiting from this too, because there's far more that comes to them with this program. This is the way the US market is moving towards. All the payers, all the big payers, Aetna, Optum, Humana, they're all shifting to trying to get physicians to go under this kind of subscription contract basis. The problem is most of the physicians aren't able to because they don't have the capability and technology. Exactly where we play, right? We're going to most of them and converting them. So again, this goes back to why our multiples are so attractive, because we're playing in a place that, quite frankly, everyone doesn't have the patience to get to themselves, but we get the benefit of doing it.
Okay, so it's not, I mean, it's like everything is like, it's like the stars are like perfectly aligned. Like you're in the right place, right time. You get massive market opportunity. You're able to create this value. You got this like arbitrage opportunity. You're paying, I don't know, 3 to 5x, and it's worth 12 to 14x based on the pure comps.
But even the better part though, Jack, and sorry, not to keep cutting you out, I'm sorry, but you're right, is, it's not the EBITDA multiple that these guys are selling or buying at. It's the revenue multiple that the analysts are giving the companies that are driving organic growth. So on that slide, I got two companies, I got Cano Health and Oak Street Health, right? If I got a second to show that again, right? Okay, look at Cano and look at Oak Street. So Cano just merged with a SPAC and they're going to go public, right? Both companies are almost the same size, right? Similar locations, similar number of patients, similar kind of revenue, but look at the profit. Oak Street's losing money and Cano's making money, but look at the enterprise value. Oak Street trades at a 13 times revenue multiple, and Cano trades at a single-digit EBITDA multiple. The reason is because analysts are saying, hey, Cano, you're going and buying these existing converted practices for higher and higher prices, but you're not able to get organic growth. Why? Because they're probably already converted. Versus Oak Street, you're doing it organically. So we're going to give you the revenue multiple because you have organic growth. And what the bankers are saying and what the market is telling Skylight as we continue to market down there is, Skylight, you're going to see a revenue multiple because it's not that you're buying practices like Cano, it's that you're driving that organic conversion over yourself. And that organic conversion is ultimately what's going to result in you getting a multiple on revenue as opposed to a multiple on EBITDA. So the arbitrage is significantly greater as a result of that. And so there's sort of two factors here, right? Strong fundamental growth, but also strong shareholder value return as we get the revenue multiple, not the EBITDA multiple.
Okay. So and just okay. So for anybody doing the math, the difference between the EBITDA multiple and the revenue multiple is how much. So let's say if you're getting the EBITDA multiple, it's only 12x. But if you're doing the revenue multiple, then is it 100? I mean, it's wait.
Yeah. Well, first of all, Oak Street's not even profitable. So for them to even get that multiple without any profits is pretty phenomenal. I mean, look, from our perspective, you're talking, it's 40, 50 times as opposed to 12 to 14 times that these companies are selling for, right? And we're buying them at 3 to 5 times. And by the time we convert them and you look back, we probably only paid about 1 or 2 times.
You know what? Let's make it simpler. Just make it simple for anybody to follow along, right? When you make an acquisition, let's say you're picking up $1 million in revenues, how much should that $1 million in revenues be valued at by the market by the time if this model works? How much is that worth?
Well, let's say we buy a practice and the practice is doing $1 million.
Yeah. And
so let's say short term, we institutionalize that practice, we make it more efficient. Now 1 million can become 1.5, 2 million, 2.5 million. Okay, let's just say 2 million.
Sure.
In that 2 million, there's about maybe 25 to 30% of people that should be generating, let's call it $8 or $10 million on their own. And so that $1 or $2 million can become $10 million organically by converting them into those value-based contracts. Your multiple on that should be, if you're Oak Street Health today, 13 times.
Okay. So basically, so that's $130 million.
Right. And what you paid for that is probably 1 times.
Okay. Wait, so you paid let's call it $5 million for that $1 million.
No, they're only generating 1 million. When I bought them, I probably only paid about 800,000 for it.
Oh shit! Wow. Wait.
I pay on average less than 1 times revenue, maybe sometimes right at 1 times revenue.
No. I get your EBITDA. we get okay. So here's the arbitrage opportunity gets even better. Okay, bottom line. Tell me because I failed math. I told you, you're picking up an acquisition.
I don't ask me math questions. Anyways, go ahead. Yeah.
$1 million, right? The thing is $1 million. The market values it at 130 million. So for every million you pick up, at some point, it's going to be worth 130 million in market cap. So
exactly.
So acquisition, you picked up 10 million in revenues. In theory, if everything works, the model works, that's going to add $1.3 billion value of Skylight.
Yeah. I mean, look, Skylight, just even work it backwards for you, Jack. Look at Skylight today. Skylight has about 150, 160,000 patients, right? And our revenues are $56 million on an annualized revenue. Actually, that's not even including the new ones that are coming in. Let's just say 200,000, near 200,000 patients generating about 56 million because they're all fee for service. They're all in that lower end scheme. Now, if you look at Oak Street Health, they have 97,000 members and they're generating 1.3 billion in revenue. So you can see how that natural evolution to the future healthcare models, which by the way, all the payers are going to, is going to result in an 8 to 10x or 5 to 10x return on increase in revenue from what you're making today. And a multiple on revenue on that is, I mean, now my math doesn't.
Okay, so right now you're basically at a run rate. Once this deal closes, you're going to be at a run rate of how much?
56 million.
56 million.
On an as-is basis today.
Okay. So in theory, you know, when your program kicks in, when your model starts kicking in at its full, you know, at max, and the market is cooperating, that's one thing. There's two parts. There's your part, and then the market has to cooperate in terms of valuation multiples, right? If those two things are working, that 56 million should be worth 130x. What is that? That's 10 billion, 8 billion value?
Yeah, that 50, exactly. That 56 million in revenue has the potential to become 400 to 500 million in revenue once all those things go into place.
So it's roughly right now, in other words, like essentially it's like Skylight essentially is already, it's an acorn, but the acorn already has the oak tree built into it. It just has to come out. So in theory, you really have $5 billion. Like right now, the company's worth $5 billion. It just has to come out.
If we did nothing else but just focus on organic growth, which by the way, analysts in the U.S. are rewarding organic growth more than M&A. So if literally all we did was organic growth, that multiple could be even better.
How many shares are at now fully? Like after everything is, you know, with the new acquisition and everything. What are we at right now? Like today?
175 million.
Okay, so what is that, about less than 200 million market cap right now?
Right now on the US side, yeah. On the Canadian side, it's about 220, 230.
Okay, so 200 million. Let's just call it 200 million. So basically, just on what you have now, let's say you did nothing else, this should be worth 25x. You know, one thing is coming to when they mature, and let's call it 12 months. By the time the model kicks in, everything else.
Right. So there's your growth rate.
At the same time, you're not stopping, right? You're not. This is
I can't stop, but there's so many deals in the pipe. I can't stop. We have to keep going.
This is the model. This is sort of like a fast car on a fast train. This is the model. Whereas what is a rap song? Racks on racks? Is that the thing?
Racks, yeah.
You know, this is so. This is incredible stuff. All right. We got the model. I don't know. This is to me, it seems like a no-brainer. I don't know why the stock is not trading at $5 right now. It doesn't make it makes no sense to me.
You know what? Market's the market, but I'm telling you, the interest we're getting, and honestly, why I think we believe we see so much participation from, you know, the likes of top-tier banks wanting to work with the company, because Skylight's carving a niche. Really, it's carving a niche in a market today where everyone's focused on one, you know, shining light, an object, and chasing that and paying high prices for it. And we're going to get to the same destination. We're just doing it in a very unique, different way.
Let's jump to a couple of questions, and then we'll kind of wrap up in a few minutes. Okay, so Morpheus asking, have there been empirical studies showing how much Medicare would save on more expensive surgical care in emergency room visits? I guess on the spending the subscription model, I guess, if they had your subscription model.
There are stats. I don't have that on me on the top of my head right now to say, but what I can say is, primary care, I think one of these stats that came up, primary care probably represents less than 10% of the total healthcare spend in the US being multi-trillion, right? But controls over 60% of the costs associated with healthcare. So just to play that in comparison, the revenue paid to primary care is less than 10%, but the cost impacted to the healthcare system is more than 60%. So it's a very important area, which is why we're seeing more money from payers to primary care, because it's going to relieve the cost downstream.
Okay. I think, Brad, I think the big takeaway, which you've never mentioned this before, but basically the model is this. I mean, for investors, the model is, here's what they need to look at. There's only one thing they need to look at right now, is for every acquisition you make, for every $1 million in revenue that you bring on, at some point, the market is going to value that by this 130x, assuming the organic kicks in, the valuations. But so basically, it's 130x. So if you pick up another $50 million in I don't know, in the next couple months, that's $5 billion. So like the company in theory could be $10 billion valuation in the next 18 months, and it's kind of baked in. So in other words, the acorn is there, the oak tree is going to come out of it.
Yeah, and again, I don't think that's hard. Look at Oak Street today; they're valued at over $10 billion market cap today, and they only have 97,000 members. Skylight's members base is bigger, but not billed under that same contract model. And it's not like we can't. We're the ones bringing those patients to that contract model. So at some point they will be. And that point is where our revenues could potentially even outpace some of these existing players in the market.
Okay, so you could outpace an Oak.
Yeah, don't go tell them that. But look, everyone's got to have. We have a long line and a long drive to get to where we go, and this is why we're so excited, because it's not about beating out one player or another. It's about literally taking a big chunk out of a large market. That's it. There's enough room for everybody, but that chunk can be large.
Great question here. This is kind of where I want to kind of wrap up with this here. How many acquisitions are in the pipeline that have the potential of being converted into this model here?
That's a great question. So every acquisition. So the way primary care has worked on average with everyone we've done, right? We've announced 6, closed 5. Well, announced now 9, closed 5. Is about 20% of patients within each of these practices are senior patients, which they're all Medicare, and almost none of them are on a Medicare Advantage plan. They're all on just your traditional fee-for-service Medicare. So every practice we acquire has an immediate potential base that can go into a Medicare Advantage plan, but they need to have that infrastructure before you can do that. And so there's already a captive audience, and that's what's so exciting about this. We're purchasing a business where you have not just an active patient base, but a captive patient base that is already, within the confines of parameters to fall into that model.
All the stuff is already built into what you're doing. So it's like it's like a done deal. It's a fait accompli. Essentially, this is going to happen.
It's just about laying the infrastructure and contracting with the payers. That's it. It's the two things, which we're already contracted with. You're just changing the contract from fee for service to managed care.
This is it's incredible. Okay, so bottom line is the market needs to understand every million equals 130 million down. It's like okay. What do you have in the pipeline right now? How much do you have in the pipeline right now? You're a 56 million run rate.
Over 100. Yeah. What's over 100 million.
Over 100 million. Okay.
Yeah.
And over 100 million is in the pipeline. The last time we had you on, you said you want to exit 2021 with 100 million revenues plus.
That's still our goal.
Okay. Can you exceed that? Is it possible that you might?
There's enough deals, Jack. I mean, look, if one person was to ask me,
close. I mean, you're pretty close right now, 56, and we're only in March. What are we in March?
I know.
First week of March.
I want look. We're not going to stop at 100. So if we get to 100, we're not going to be like, oh, okay, we hit our target. That's done. No, it's the reason we're having to announce ahead of other closings is because honestly, there's enough coming in, and the team is pushing. We got to keep moving. So demand's just going to keep growing, and we're just going to have to continue to build the infrastructure so we can keep up the pace.
Wow, this 130x is an incredible number. Okay, Brad, last question here is what's in the pipeline right now? What else do you have? What kind of news flow should we be looking at? acquisitions. What do you have in the next couple weeks?
So we're working on closing, obviously, the larger acquisition that we announced. So that should be coming up shortly. We do have these deals that we'll go through, and again, so these three will set to close by the end of April. There's more marketing. I believe we're going to be presenting at a few more healthcare conferences on the U.S. side. We'll update shareholders, of course, as we go through the NASDAQ application process. We're also looking at some pretty impressive additions to our board as well. So that'll be something that comes in as well. And then, look, keep, like I said, it wasn't long before we had to come with the next wave of acquisitions. These three are just the start of that wave. So Q2 hasn't started yet. I was kind of hoping for Q2 to kick in to start the next wave to give my team a little time, but it doesn't look like we have that choice. So we're going to, continue to make some announcements as we keep going.
Okay. Prad, on that note, I want to thank you, and I want to have you back on for the next acquisition so we could get to this, this thing over here at the bottom of the screen.
There you go. All right. Thanks, Jack. It's always a pleasure.
Thank you again.